Welcome back, everyone. It is fantastic to have you with us for another deep dive. You're on the Smart Capital School of Financial Literacy channel.
It is good to be here. We have uh, a genuinely fascinating set of documents to go through today.
We really do. And I have to be honest, usually when we talk about, financial regulation or SEC filings, people's eyes tend to glaze over a bit.
Right.
It usually sounds dry, bureaucratic, and maybe a little boring. But the material we are looking at today, it feels different. It feels like we are witnessing a potential Cambrian explosion in financial innovation.
That is a strong opening. But looking at the source material, it isn't an exaggeration. We are looking at a speech and a detailed analysis regarding something called Project Crypto.
Right. And to be clear for everyone listening, this isn't about which coin goes to the moon next week. This is a massive strategic shift at the SEC. The source material outlines a plan designed to explicitly make America the crypto capital of the world.
And to set the stage, we have to understand the context. For years, the narrative around crypto in the US has been defined by confusion. The industry has often complained about regulation by enforcement.
Which is basically getting sued without clear rules beforehand.
Exactly. But what we are seeing in these documents is a pivot. It is a concrete plan to move U.S. markets from what they call an analog past to an on-chain future.
So the mission for this deep dive is pretty clear. We're going to unpack exactly what this new framework looks like. We're talking about super apps, innovation exemptions, and why the SEC believes this is the buttonwood tree moment for the 21st century.
That buttonwood reference is key, and we will get to that history. But before we get to the solution, we have to understand the problem. The source material starts with a stark look at the current state of the U.S. market. And frankly, the data is a bit alarming.
It really was. I think most people, myself included, assume the stock market is just this, ever expanding beast that always gets bigger and better. But the data presented, it paints a totally different picture. It suggests the market is actually shrinking.
It is shrinking in terms of options. They point out a significant contraction in public markets. You go back to the 1990s, there were nearly 8,000 public companies in the United States.
8,000. Wow.
Today, that number has dropped to around 4,000.
That is basically cut in half. Where did they all go?
Mergers, acquisitions, or simply staying private for longer? And look at the Wilshire 5000 index. It was named that because it tracked roughly 5,000 investable stocks. Today, despite the name, it only contains about 300 stocks.
Okay, so we have fewer companies to invest in, but play devil's advocate for me here. The market is still hitting all-time highs, right? Why does it matter to the average listener if there are 4,000 companies or 8,000 as long as the line goes up?
It matters because of concentration risk. The analysis highlights that because there are fewer public companies, investors, meaning you, your retirement fund, your pension, are all jammed into the same few stocks. They note that the Magnificent Seven tech stocks now represent roughly 30% of the S&P index.
30%. So let's unpack that for your 401k. Basically, you think you're diversified because you bought an index fund, you think you own the market, but actually, nearly a third of your money is riding on just 7 companies.
Precisely. If one sector takes a hit, there is nowhere else to hide. The argument in the source material is that regulatory overreach, the administrative state, has made it so difficult and expensive to go public. We're talking millions in compliance costs just to ring the opening bell that companies just aren't doing it.
So all the big growth stays private. The venture capitalists get the huge gains, and by the time a company goes public, the massive growth phase is already over.
Exactly. And this stifles prosperity for the average American. And Project Crypto is presented as the countermove. It is an attempt to reverse this trend by opening up new ways to raise capital that are cheaper, faster, and more transparent.
And here's where it gets really interesting. To explain why we need this shift, the SEC leadership uses this incredible historical analogy. They talk about the paperwork crisis of the 1960s.
This is a great piece of financial history that most people have completely forgotten.
I love this visual. So picture Wall Street in the late 1960s. The market is booming, volume is way up. But back then, a trade wasn't a digital signal, it was physical paper.
Literal stock certificate. Elaborate pieces of paper with engravings on them.
Right. And to settle a trade, you had to physically move that paper from the seller's broker to the buyer's broker. They had armies of messengers runners pushing carts full of securities or riding bicycles through lower Manhattan.
It was a logistical nightmare. And the volume got so high that the physical system literally broke. The back office, the people processing the paper, couldn't keep up with the front office traders making the deals.
The sources mentioned that the backlog was so bad, the exchanges actually shortened their hours. They eventually had to close on Wednesdays. Imagine that today. Imagine the New York Stock Exchange just putting up a closed sign every Wednesday just so the clerks could catch up on filing.
It sounds absurd now, but it was a real crisis. Firms were failing, going bankrupt because they couldn't clear trades. They didn't know who owned what anymore because the paper was stuck in a pile somewhere. Now, here's the crucial connection. The SEC back then didn't say, trading is too fast, let's ban trading. They didn't try to slow down the economy to match the speed of paper.
Right. They innovated.
They helped create the DTCC, the Depository Trust and Clearing Corporation. They immobilized the paper certificates in giant vaults, literally stacking them on shelves, and switched to computerized ledger entries. They digitized the process.
And that is the analogy for today. The friction we have now isn't paper, it's the separation of systems. We have these siloed analog systems trying to keep up with a digital world. We have T+1 settlement, meaning it takes a day for a trade to actually finish. The move to on-chain markets is the modern equivalent of solving that paperwork crisis.
And that brings us back to the Buttonwood Tree. That agreement in 1792 under the tree gave birth to the NYSE. It was a simple, elegant structure for its time. The argument is that blockchain is the next evolution of that agreement. It's about updating the plumbing of the entire economy.
So let's get into the specifics of Project Crypto. They lay this out in pillars. The first pillar is all about reshoring and clarity.
This directly addresses the complaint that the U.S. has been hostile to crypto. The source material notes that many crypto businesses moved overseas offshore because they simply didn't know if they were breaking U.S. law. They were operating in a gray area, and business hates uncertainty.
And the goal now is to establish clear rules of the road. The SEC chairman talks about using the Howey test, which is the standard from the 1940s for deciding if something is an investment contract, but providing clear guidelines on how to apply it to crypto.
The intention is to allow issuers, the people creating these tokens, to categorize themselves without fear of a lawsuit. They want to create a framework where you can look at the economic reality of the token and know, okay, this is a security, or this is a commodity, or this is a currency.
But wait, a lot of crypto folks hate the idea of being called a security. They think it brings too much red tape. The sources make a point that being a security shouldn't be a scarlet letter.
Right. The SEC's argument is basically, if you are raising money from the public, you are a security. Deal with it. We will make the disclosure rules fit the technology so it isn't impossible to comply.
They gave a great real-world example here to show what kind of innovation they want to encourage. They mentioned Senator Bernie Moreno. Before he was a senator back in 2015, he put car titles on the blockchain.
This is a perfect example of utility. Transferring a car title is usually a massive hassle. You go to the DMV, you stand in line, you fill out paperwork, you wait for the mail. It is slow, expensive, and prone to error.
I think everyone listening has had a DMV nightmare story.
Exactly. Putting that title on a blockchain makes it instant and verifiable. You sell the car, you transfer the token, and the ownership record is updated globally instantly.
And the SEC wants to encourage that kind of entrepreneurship. They don't want someone like that worrying they're going to get sued by the federal government for unregistered securities trading just because they digitized a car title.
And this extends to capital formation. The plan mentions creating legal pathways for ICOs, initial coin offerings, airdrops, and network rewards.
Which is huge because right now, if you look at a lot of these new crypto projects, the terms and conditions explicitly say not available to U.S. citizens. We are being excluded from the ground floor of these networks because of regulatory fear.
And Project Crypto aims to end that exclusion. The idea is to bring that capital formation back to the U.S. so Americans can participate in the upside.
Okay, let's move to Pillar 2. This one hits close to home for anyone who actually owns crypto or, frankly, anyone annoyed by how slow banking is. It's about custody and the super app.
This touches on a moral argument presented in the speech. They frame the right to self-custody, holding your own private keys, as a core American value. It's treated as a property right.
Not your keys, not your crypto, as the saying goes. Basically, if you want to keep your assets on a USB stick in a safe, the government shouldn't stop you. But they also acknowledge that not everyone wants that responsibility. My grandma certainly doesn't want to write down a 24-word seed phrase and bury it in the backyard.
Correct. Losing that seed phrase means losing the money forever. It is high risk. That is where institutional custody comes in. The source discusses the need to modernize rules so that registered intermediaries, banks, broker-dealers can actually hold crypto for clients.
And this is where we need to get technical for a second. The sources critique something called as AB 121. What is that, and why does it matter?
Staff Accounting Bulletin 121. It sounds boring, but it was a massive roadblock. It effectively forced banks to treat any crypto they held for customers as a liability on their own balance sheet. That meant for every dollar of Bitcoin they held for you, they had to set aside a dollar of their own capital.
Which makes it completely unprofitable. No bank is going to do that.
Exactly. It was a soft ban. Project Crypto intends to scrap that, allowing banks to hold crypto just like they hold stocks or bonds off balance sheet. This opens the door for your regular bank to offer crypto services.
And that leads to the super app vision. I have to say, this sounds like such a quality of life upgrade.
It addresses the fragmentation we all deal with. Right now, think about your phone. You have a banking app. You have a brokerage app like Fidelity or Schwab for your stocks. And then you have Coinbase or Kraken for crypto.
And moving money between them is a nightmare. I sell Bitcoin, wait 3 days for the ACH transfer to my bank, then wait another 2 days to move it to my brokerage to buy Apple stock. It's a week-long process.
The Reg Super App approach proposes allowing a single broker-dealer to offer all of this under one roof, trading securities, crypto, lending, and staking.
So one app. I can buy Apple stock, sell Bitcoin, and lend out a stablecoin all in the same place. Instant liquidity between asset classes.
That's the vision. And from a business side, it eliminates the need for getting 50 separate state money transmitter licenses. They want to create one federal framework. It's about efficiency and reducing that friction to zero.
That would be a game changer. Okay, let's talk about Pillar 3. This is where we get into the heavy lifting of market structure, on-chain markets, and DeFi.
This is perhaps the most forward-thinking part of the plan because it acknowledges a new reality, software that runs without humans.
They call this on-chain software.
Right. In traditional finance, there's always an intermediary. Person, a company, a clearinghouse. But in DeFi, decentralized finance, you have automated market makers, or AMMs. These are just pieces of code smart contracts that sit on the blockchain and facilitate trades automatically.
So if I swap tokens on Uniswap, I'm not dealing with a company, I'm dealing with a robot, basically.
A robot that lives on the internet and belongs to no one. And the SEC is saying they intend to protect pure publishers of code.
That is a significant distinction.
It is huge.
Yeah.
It means if you just write the code and put it out there, you aren't the financial intermediary subject to banking laws. But if you are a centralized company running a website that uses that code and taking a fee, then you are an intermediary. They are trying to draw a clear line.
They also mentioned side-by-side trading.
Yes. This goes back to the super app concept. They want exchanges to be able to list traditional stocks and crypto assets side by side. Imagine the New York Stock Exchange lifting Bitcoin next to Ford Motor Company.
And to make that happen, they talked about modernizing something called Reg NMS.
Regulation National Market System. This is the constitution of the U.S. stock market. It dictates how trades are routed and executed to ensure you get the best price. But it was written for a world of servers and cables, not blockchains.
The source suggests amending it to allow for 247 trading. Now, hang on. Do we really want 247 trading for stocks? It's kind of nice to have a break at 4:00 p.m.
It's not about whether we want to trade at 3:00 a.m., it's about the capability. If the underlying technology is blockchain, the market naturally never closes. The current rules create market distortions because they force this new technology to act like the old technology, literally turning off the software at 4:00 p.m. They want to fix that so the U.S. can compete with global markets that don't sleep.
This all sounds great, but we know regulation usually moves at a glacial pace. How are they planning to jumpstart this? Because usually, waiting for the SEC to write a rule takes years.
That is where the innovation exemption comes in. Think of it as a sandbox or a safe harbor.
Okay, let's unpack this innovation exemption. How does it work? Is it just a free pass?
No, it is definitely not a free pass. The idea is that instead of waiting years for permission, builders can go to market immediately if they follow a set of principle-based conditions.
So ask forgiveness, not permission, but with really strict guardrails.
More like pre-approved permission if you follow the rules. The source mentions conditions like strict transparency reports and whitelisting investors. And this is critical. They specifically mentioned using compliant token standards, like ERC 3643.
Okay, you dropped a technical term there. ERC 3643. What does that actually do?
Think of it like a digital ID card that is stapled to the token itself. In the old world, a compliance officer at a bank has to check your ID before you can trade. With ERC 3643, the token checks your ID.
The token checks my ID.
Yes. If you try to send that token to a wallet that hasn't been verified, say a wallet belonging to a known money launderer or just someone who hasn't done their KYC, the token literally won't move. The transaction fails on the blockchain.
That is fascinating. So the regulation is baked into the code. The code prevents the crime before the regulator even looks at it.
Exactly. And because the compliance is automated, it allows the SEC to apply a minimum effective dose of regulation. You used a great metaphor in the speech. They don't want to create a Procrustean bed.
I had to look that one up. Procrustes was a figure in Greek mythology who had an iron bed. If guests were too short, he stretched them. If they were too tall, he chopped off their legs to make them fit.
A gruesome image, but an incredibly accurate description of bad regulation. Forcing a crypto business model to fit into 1930s banking rules is like chopping off the legs of the business. It kills the innovation. This exemption is about fitting the bed to the guest, fitting the regulation to the technology.
So, taking a step back, we have gone from the Buttonwood Tree guys signing a parchment under a tree in 1792 to the blockchain. The narrative here is really about the US deciding to stop watching from the sidelines.
It's a statement of intent.
Mm.
The U.S. intends to be the builder, not just the enforcer. They are betting that by creating clarity, the Cambrian explosion of innovation you mentioned at the start will happen here rather than in Europe or Asia.
It really feels like a turning point. We are moving from don't touch crypto to how do we rebuild the stock market using crypto?
That is the core message.
Yeah.
It isn't just about trading Dogecoin. It is about using the technology that underpins crypto to make the entire financial system faster, cheaper, and more accessible.
So, what does this all mean for the listener? We've covered a lot of ground market structure, super apps, custody, but boil it down. Why should they care?
It means the friction is disappearing. It means that in 5 years, the idea of banking hours or settlement days might look as obsolete as a rotary phone. Your money becomes live, 247, and the cost of moving it drops to near zero.
And that raises an important question to leave with. If this plan succeeds and all assets, stocks, bonds, car titles, maybe even real estate deeds move on chain, how does that fundamentally change the concept of ownership?
That is the deep thought here.
Because right now, we trust the bank to tell us what we own.
Exactly. If liquidity becomes instant and global, and ownership is just a token in a wallet you control, the middleman disappears. But it also means you are more responsible for your own assets than ever before. It changes the plumbing of the entire economy, and we are just now seeing the blueprints.
A truly provocative thought to end on. It's not just about the coins, it's about the plumbing. We will definitely be keeping an eye on how Project Crypto unfolds.
Absolutely. There will be a lot more to discuss as these proposals turn into actual rules.
Well, that is all the time we have for this deep dive. Thank you for listening.
See you in the next session.